Warren, it's lovely to be meeting face to face in person again. We are sitting far apart, just to note social distancing is still with us.
Definitely being safe.
I think, top of mind when we think of markets currently and where we are, the main thing when you open any publication is around inflation and the impact that would have on markets. Can you give us a little bit of insights on that?
Yeah, I think the inflation story has been with us for quite some time. If we just a little bit of context, if we go back to the 2008 financial crisis, Americans dropped interest rates incredibly low, the Europeans did the same, and there was this speculation by people that were trained in economics like me that low interest rates for a long period of time would cause inflation. It would cause people to spend too much, cost of living would rise, wages would rise, and eventually the reserve banks would have to recover by raising interest rates, and that would be bad for markets. What happened was we had no inflation for a decade. And so going up to now, what we're seeing is kind of the first arrival of inflation in the US particularly. And initially, earlier in the year when people started to talk about this, they were saying it's what they call transitory inflation. And so just a bit of context, what is that all about? It's saying that at lockdown last year, so when the world went into lockdown early 2020, the world kind of stopped moving. So that meant that the price of goods collapsed. And when the price of goods collapsed, there was only one way for the price of those goods to go again, and that would be up. And so what we saw was if you went from March 2020 to March 2021, the prices rose. And so that difference in price is what the economists would call inflation. And so commentators were saying, well, that was normal because prices collapsed a year ago. So it's only natural that if they rise from last year to now, that's a one-off event because of a big pandemic and it's not a long-term issue. Fortunately or unfortunately, the world is now unlocked to some extent. Things are moving again. But what we're seeing is that these rising prices are not slowing down. Prices are continuing to rise month after month after month. And that means that we are in an environment where inflation in America is now an issue. It can't be transitory anymore. At the same time, we're seeing the price of oil rising. We're seeing the price of other commodities like copper, coal, gas, all of those rising all the time. So that means that we're going to see a big rise in cost of living for Americans, and that's going to force the Reserve Bank in America, the Federal Reserve, to do something. And they've really only got two main tools. One is that they stop pumping extra money, extra liquidity into the American economy, into the American markets, and that's what they're starting to do now. So they're starting to reduce that support for markets. But the second one will be that they start to raise interest rates. And at the moment, even the speculation about raising interest rates causes markets to fall. So we are in an environment where prices are rising, and there are a couple of reasons for that, but the reaction to that is important here, that markets will, to some extent, panic a bit when they see that this inflation story does stay and does remain an issue. Now, just quickly, I know I'm on a monologue here, but it's in lots of economic history here. Prices are rising for a couple of reasons. One, because as the economies unlock around the world, which is a good thing, right? We're kind of getting back into, maybe not as much in South Africa, but in the rest of the world, business is being done again. So the demand for goods is rising. And lots of factories were closed for quite some time, so they're struggling to keep up with demand. And we're seeing that in microchips, for example, where cars, computers, almost any device in the world now needs a microchip, and there's a massive shortage. So that's causing the price of microchips to rise. And because new cars can't be made, we're seeing the price of second-hand cars rising. And then the few cars that are being sold and are being manufactured, their prices are rising. At the same time, these commodity prices rising, so the price of oil going up and the price of gas and all of those things, is also because there is a constraint in supply. So there are lots of places where the supply of oil isn't as big as it was in the past. For example, in the US, the fracking industry that was supplying a lot of oil in the past is basically dead. And so we're seeing prices rising there as well. And that concern about inflation is a big issue. It is something that will cause markets to go into this kind of state of panic But what we need to know is there is an underlying positive, which is the economy is opening up. The economy is starting to move again. So we're worried about inflation. We're watching it. A lot of the way we construct portfolios has been designed to cater for a high inflation environment. But it's not going to stop the volatility. It is going to cause markets to be rocky and uncomfortable while that's happening. So I mean, I think it's something we need to focus on as ourselves, as the people managing the investments. But for our clients out there, just to understand that we know about it, we're managing portfolios to cater for it. And one of the things we're doing when you're committing new money to markets is we are phasing in over kind of a 3 to 6 month period just to cater for this volatility. But we're not too panicked about inflation. We think it will come into the system for a period of time and will go out again. If that prediction is wrong, we haven't built the portfolios for only one set of conditions. We have built them for a range of different outcomes. For example, if inflation stays in the system for a long time.
Diversification again.
Exactly right. And I think in South Africa, rising oil prices, it sounds funny to say, but rising oil prices is good for us. You can see it in the strength of the rand. So when commodity prices are rising, the rand strengthens. And similarly, when commodity prices and especially oil prices are rising, we see the American stock market going up. So this inflation story is a bit of a mixed blessing for investors. And just understand that we will use rand strength to get that local offshore balance right for our clients in their portfolios. But at the same time, the JSE is benefiting from these rising commodity prices. So I think it's something to watch. But truthfully, for investors, don't panic about it. We'll panic on your behalf. We'll make sure that the diversification is there for you. So, Yolande, I think to just change the subject completely. As we're seeing vaccinations roll out in South Africa, and we're seeing the lowest form of lockdown that we've had in our time since the pandemic, we're seeing a new range of issues arising, and especially around people that have kind of been in lockdown for quite some time. A lot of our clients, haven't really gone out and ventured out, since March 2020. And that's starting now, and for us, we're starting to see some of our clients face to face. But it's created a new kind of dynamic that people need to be aware of. Can you tell us more?
Yeah, there's even a name for it. It's called re-entry anxiety. So it's how we do this new normal. And is it a new normal? We've been in lockdown for about a year and a half, in and out, and we formed new habits. So now, with coming out again, we need to form new habits, and it's hard for people. It's change again. So for people that's been in isolation for quite a while, some clients just went on. They just never changed their way of being. But for those that did, it is hard. And there was a lady by the name of Judy Klippen. She's a master life coach, and she wrote an article recently just about how to get over this anxiety and how to get into a normal life again. And the first thing that she says is just name it, accept that it is that. We all have this anxiety when there is change, and talk about it, speak about it. And then the other thing is to take small steps. If you haven't been out, then go with a small group of people for a short period of time when you start, and then sort of increase that number and increase the time. So there are ways of doing it slowly, and for us, it's about being comfortable with our clients in meetings. So whichever way they want to engage with us. We've done this research a while ago where we asked our clients how they want to engage with us, and what came out from that was that they wanted a bit of a hybrid. So some meetings online still, and others face to face. And then for some clients it was only digital. So please speak to your financial advisor. Tell them how you feel, what you would be comfortable with. We are seeing clients face to face again, and we are keeping safe. Our planners are all vaccinated. We do keep our masks on in the office. We do ventilate properly, sanitize. All of that is happening, and we ventilate even when it's really cold. So just so that
you can see my jersey in November.
So, but please let your financial advisor know how you want to engage with us. and what you're comfortable with.
Yeah, and I must say, I think I had a bit of that anxiety myself coming out of this hard lockdown and just venturing out into the world. And the first time we got asked for a face-to-face meeting with the client, what was a little bit kind of scary as a concept. But what was interesting was how nice it was. And just to see that connection again, and actually to see the person, and so certainly as a business, we're not going to force anybody to stay digital or to only be face to face. We will do what you want, but certainly we are people lovers. We like to see our clients. We are people, I guess. And so seeing human beings again is really nice. And I must say, for me, it's quite emotional actually to see some of the people we've known for decades. And we haven't been able to see them for a year or two. It's been really nice to see them. So I think, a nice article by Judy. Thanks, Judy.
And like you're saying, really lovely to have that contact. It's always interesting how to greet. We used to hug some of our clients. Do you do that again? Do you not? So there's lots of change and lots of things going on. But it is a slow process and a step-by-step, small steps, I guess. So just on that, maybe just clients are very worried about markets where they are. It seems like the overseas market is quite expensive. South Africa seems to be quite cheap still. The Chinese regulator had quite an impact on our market specifically, especially on Naspers, and that had a short-term effect. But maybe if you can just give us an idea of where we stand currently as market stand today. Most easy question I can ask.
Knowing what we know today, right now, for the next 10 minutes, I think we are in a state of flux. And I think it's important to understand that this kind of inflection point in the world is being driven by lots of different factors at the same time. So we've got this, the Chinese government's approach to their economy is certainly in a state of flux at the moment. It's causing everybody a huge amount of anxiety because it's very unclear whether they're anti-big business, anti-business just in general, whether they're trying to isolate, whether they're trying to exert kind of economic power on the rest of the world and control things. It's very difficult to understand what's going on there. And so I think that that state of flux is there, and it's going to be with us for quite some time. At the same time, there are different views on this. So some investors are using that drop in the Chinese market as an opportunity to buy into a lot of Chinese businesses at what they feel are very good prices, and other investors are saying avoid China at all costs for quite some time until we know what the regulatory environment will be in the future. And it's a multi-pronged approach by the regulators. It's not just on tech or just on big business. It's across almost the entire economy. So it is something to watch. At the same time, those supply constraints of oil and gas in Europe is an issue. So Americans and the Europeans are going into winter. I guess they're all in the northern hemisphere, but the Europeans are struggling to get to get enough gas to keep their houses warm, keep their economy going. They are looking at the prospect of energy shortages. So this transition from coal and nuclear to renewable energies is in a state of flux in Europe as well, and they're to some extent heavily dependent on Russian gas. And there's speculation that the Russian president is using his power there to get more influence. So there is a lot going on. At the same time, in South Africa, we're seeing this rising commodity cycle having a very positive impact on our economy from the point of view that we're getting trade surpluses. So in other words, we're making more money in dollars than we're losing. We're making more from the way we are exporting than what we're importing. So those trade surpluses are good for us. It causes the rand to be strong. It causes us to build reserves as a country. It also gives SARS a lot of room to breathe because they're collecting more revenue than they planned. So there are some very nice tailwinds that are not of our own doing, and no one in our government is taking kind of trying to take responsibility or credit for that. It is an economic tailwind that's benefiting us, but we don't know what the story looks like over the next 6 to 12 months. So our view is don't panic about the uncertainty. It is presenting some buying opportunities for those that need to commit money to the markets. If you're fully invested already, it's probably a time where you might see a lot more volatility, so prices rising and falling, but there is a general drive for prices to rise. So that's specific to South Africa. The American market will be volatile. We think that the American investors love the fact that Biden's not able to change a lot of the kind of anti-business steps that he would have liked to implement. And so, that's causing markets to do okay there. And Europe is always a complex, kind of messy environment that does present some opportunities for investors.
Yeah, exactly. So I think, again, just from our side, the structure of your portfolio is extremely important. Diversification, having the right offshore allocation. Again, if the offshore allocation is not where it should be, now is a good time to take some money out. We're still below that 15 Rand 50 to the dollar, and that is the levels where we take out money. And I think that is it from me.
Thank you very much, Yolande. I know you love to do these media shows, and I guess for our clients, we would say stay the course, don't panic, leave the worrying to us. We'll tell you when to panic, and we certainly don't think that's the environment now. And certainly it's been a dramatic year. November's the elections, and that's going to be interesting as well. We don't know the results yet. And we'll probably give a good update on that at the end of November, beginning of December. So until then, stay the course. Please touch base with us if you have any questions or any concerns, and we'll chat again.
Thank you.